Welcome back. Well, the markets from the word go have not done much at the index level, but there are still some stocks that are firing away, notably Idea, ITC, some of the oil marketing majors, and Cummins, of course, among the mid-caps after good numbers. Well, let's shift back, therefore. We have a little, as the market catches its breath, let's shift and discuss the macros on which this budget is based, the tax estimates, the fiscal deficit arithmetic, all that. Deepali Bhargava, the economist at Credit Suisse, joins us now. Well, Deepali, first your comment on the fiscal targets itself, the fiscal deficit target, the revenue deficit cut, which we have not spoken about, and the primary deficit going down all the way to 0.3. Is it a AAA for the government for that?
Right. Hi, morning. Actually, most of these targets are pretty much in line with our expectations. I think the budget has actually hit the right notes on most of these targets. So a fiscal deficit, we were looking at 3.2% of GDP, and I think this is the best they could have done at this point in time, which gives them some space to spend as well as some space to consolidate. Revenue deficit, if you look at the trend over the last few years, I mean, it's not just this year, we've actually seen a reasonable amount of drop very consistently over the last few years. And it's, I mean, frankly, this together with the way the government has drafted the budget is very good news for the market and even from the growth perspective, because if they're able to bring down their revenue and primary deficit in a meaningful way, it does ease up space to do a lot of other stuff, which is precisely what has happened in the budget. So although overall government spending has gone down by about 0.5% of GDP, what you notice is that the entire drop has actually happened on the revenue expenditure side. And that's really the benefit you get on revenue deficit when you talk about the cut there. So one, they're letting, so there is a bit of crowding in happen there because you're cutting down your revenue expenditure, putting more resources on a capital expenditure, and at the same time making a very meaningful, notable effort to cut down and stabilize market borrowing. So in a way, not crowding out private investment so much. So I think both these signs on the big numbers are very positive from the growth perspective.
Okay, Deepali, good morning. The next big issue, of course, that we'll be dealing with is the RBI monetary policy. Is it a given now that we'll have another rate cut from the RBI?
We were of the view that in February we will see the rate cut, and the last rate cut we have is that despite a pickup in oil prices that we've seen, I think in CPI inflation will remain much below RBI's own projections, and I think fiscal consolidation and a very good mix of spending that the government has come out with, I think it does call for a rate cut by the RBI in the Fed policy.
But does money get cheaper either in the market or even for borrowers from banks? I'm just trying to play the other argument. Fiscal deficit is at 3, and the finance minister has admitted they will hit pause at 3. Inflation is at 3.4. It doesn't get better than that. So is the bond rally over? Will banks cut even further, irrespective of what the RBI does?
Right. I think our view is that the bond rally could be over, so there is likely to be a breather in the near term, because most of the positives, like a positive stable market borrowing plus the rate cut, are already factored in. Plus, I think this big issue about the buybacks, etc., which happened yesterday and because of which the bonds sold off. I think the supply pressure could remain at least in the first 6 to 7 months, because buybacks, etc., will happen only towards the end of the year. So I think, yes, I think the best part of bond rally is probably over. We expect 10-year to remain around 630 or so in the near term. But as our inflation trajectory indicates a pickup later on towards the end of the year, I think we should see a move higher in yields from there.
A final question to you on growth, Deepali. 11.8, I think, is the nominal GDP growth expectation. This is a budget where we have really been shooting in the dark. Current years are also estimates, and of course next year's estimates are based on tentative current year estimates. What kind of a legitimate, what kind of a real and nominal GDP growth you are working with? Also your comments on this 12.7% tax revenue expectation.
Right. So I think on GDP, we're working with a pickup in growth next year. So assuming you end up with a 6.9% this year, we're assuming a pickup of about 30 basis point next year and working with a nominal growth of about 11.5%. I think having said that, yes, the budget probably puts in a higher number on nominal growth, but I think in a long time, the revenue assumptions are actually pretty realistic. And when I say that, I think even a personal income tax, which has got a little bit debatable with a 25% a sharp hike, which has been priced in, I think that kind of incorporates the IDS-1 plus some gains which are likely to happen from a shift from informal to formal. But I think a big chunk, which is IDS-2 and special dividend, which is likely to be about 0.5% of GDP, is still not factored in the budget. So I think this time they've actually been pretty prudent in terms of factoring in revenue hikes as well, and that's the reason you've not seen, you know, a lot of dole-outs, a lot of populist measures happen on the expenditure side. The only disappointment on the revenue side could yet again be on divestments, but I think you will have enough cushion from the demonetization gains, which are not priced in, to be able to make up for that.
All right, Deepali Bhargava, thank you very much for that. We have to take a break. We are coming back with the Bajaj Auto sales numbers in January. Looked a shade lower than